Bismillahirrahmanirrahim. This video is about the Great Depression in the United States, starting from 1929 and extending for more than a decade. We look at the causes of the Great Depression according to the economist John Kenneth Galbraith. So first, the history and the background. The Great Depression was the worst economic downturn in modern history, beginning with the stock market crash of 1929 in the United States. By 1933, economic activity in the US had declined approximately 30% from the 1929 peak. One quarter of American workers were unemployed. Industrial production fell by nearly half, and prices declined sharply, falling 15% from 1930 to 1933. The agricultural prices dropped 60%. Worldwide trade and capital flows contracted sharply. International trade fell by over 50% between 1929 and 1934 as nations struggled. So as we can see, this was quite a serious situation in the United States, but also in Europe and other places. So what caused the Great Depression? We're going to look at 5 main causes. The first is the inequality of income and wealth, which is the disparity in the distribution. The second is the problems with the corporate structures. Third is the vulnerable banking system. The fourth point is issues abroad impacting US exports. And the last one is ignorance of macroeconomics. So let's have a look at each one of these in detail. So the first point is about the concentration of wealth and disparity. High inequality leads to unstable spending patterns, as the wealthy do not consistently spend a high portion of their income. It also increases risk-taking behavior that can destabilize the economy. So let's have a look at the concept of the marginal propensity to consume, which is called MPC. It's the marginal propensity to consume. And basically what this means is what proportion of the income is spent on consumption. So let's say we have two people, we have A and B. Mr. A is a middle class person with an average wealth. He doesn't have any savings. And on the other hand, you have Mr. B, who is a millionaire. He has an asset worth $100 million. Now, if this guy is given $50,000, how is he going to use his $50,000 vis-a-vis if this guy is given $50,000, how he's going to spend? Because he doesn't have any assets or wealth, most likely he's going to use almost 100% of his wealth, or 90%, on real goods and services like food, clothing, rental payment, car installments, and so on and so forth. On the other hand, if this guy B has an additional $50,000 over the $100 million, this will not affect his consumption of real goods and services. So even before he got this 50,000, he had his food on the table, he had clothes, and he had the cars and the house, and everything was sorted. So this 50,000 doesn't really make any impact on his lifestyle or his consumption patterns. So most likely what he's going to do with the 50,000 is put the money in the stock market, do some gambling on the derivatives market, FX. So you have FX trading, currency trading, and so on and so forth. So this is all wasteful spending or wasteful investments. So this doesn't add any real value. So whatever money goes into the stock market or derivatives or FX, it's really not adding value to the real economy. So on the other hand, when this guy spends $50,000, that money goes into the pockets of a real producer. So let's say Out of the 50,000, the guy spends $10,000 on food. So the seller of the food will take that $10,000 and spend on his children's education. So starting with this 10,000 from the person A to the food seller, and then 10,000 would, out of that 10,000, let's say 5,000 goes for children's education, and then the school uses it for maintenance and cleaning services, so that $5,000 go into the pocket of the maintenance company. So you see it has a multiplier effect. So when the money enters the pocket of a person with a high marginal propensity to consume, it has a multiplier effect on the economy. Its impact is widespread, and then the multiplier effect on the economy and the GDP is much higher. On the other hand, these are all non-value adding activities, so they don't add to the GDP of the economy. So that's the concept of the marginal propensity to consume. And how it ties into the Great Depression is what the author is saying is that there was a huge concentration of wealth, so we had more B category type of people and fewer A category type of people. And of course, these people were investing their money in speculative activities and high risk activities. They were not investing into the real market, and because of that, of course, there was a fall in aggregate demand. The demand for real food, real clothes, and real goods and services, that fell because these A category people did not have enough money with them to spend on real goods and services. So that's the number one cause for the Great Depression, according to the author. The second cause of the Great Depression was the corporate structures. So during the 1920s, a significant number of holding companies controlled large portions of the US economy. These holding companies didn't manage the businesses directly, but owned shares in companies that did. They financed their operations by issuing bonds, using the dividends received from these operating companies to pay the interest on these bonds. This setup depended heavily on a booming economy where the operating companies could generate enough profits to pay substantial dividends. So here's how it worked. So there was what's called as the holding company. That's like an umbrella company, and under that holding company there were multiple operating companies. So these are small companies, and this is like the parent company. So these are like the children companies, holding and operating companies. So this holding company was taking a lot of loans and issuing a lot of bonds. So it had to pay interest payments to the bondholders and banks. And the expectation was that these operating companies would continue generating enough income to pay the bonds. So that was the assumption. And for that to happen, these operating companies had to remain profitable, and the economy was expected to continue to boom. However, as the economy began to slow down, these operating companies saw a decline in their sales and earnings. Despite this downturn, the holding companies continued to prioritize paying dividends to cover their bond interest obligations. So these operating companies continued channeling the funds to the holding company to make the interest payments. Now, this was crucial for the holding companies to maintain their creditworthiness and continue to attract investment. So these holding companies had to honor their obligations, otherwise they would not be considered as creditworthy and would not be able to attract new investments. So this was the parent company, so all the investments and the loans would come here. So they had to maintain their creditworthiness. So simultaneously, these and other companies across the market had taken on excessive debt with the assumption that the economic boom would continue indefinitely. This over-leveraging was risky and left these holding companies vulnerable to economic downturns. And the second point is adding to the precarious financial landscape, banks and financial institutions engaged in risky practices such as bundling good and bad assets. So this involved combining good and bad assets into a single investment products, which were then sold on to the investors. Many investors were unaware of the risks involved, especially with the bad assets hidden with these bundles. So this is a very common practice. We also saw in the global financial crisis in 2007 that good and bad securities, the mortgage-backed securities, they were bundled together. So let's say a bank issues 100 loans, and then out of these 50 loans are given to good borrowers and 50 loans are given to weak borrowers. So the bank could basically sell this, make it a bundle, and sell it as a product to investors. However, when these 50 loans default, then the entire bundle will default. So this was one practice which happened in 2007, and it also happened in the 1920s. So we didn't learn anything from history. We're still bundling good and bad assets together, and this was also a reason for the failure of banks and huge and hefty losses to the investors. In addition, banks facilitated and encouraged the purchase of stocks on margin, meaning the banks lent money to investors to buy stocks with only a small down payment. This practice was similar to gambling on the continued rise of stock prices, which proved disastrous when the stock markets began to crash. So banks were giving loans for purchasing stocks. So instead of real businesses, banks were giving loans to the investors, and the investors were speculating and gambling on the stock market. And obviously, when the markets went down, the investors were not able to pay off the loans, and therefore they defaulted on their loans since the stock markets went down, and that led to bank failures and losses for the banks and the investors. So as the stock market crashed in 1929, the situation worsened dramatically. Holding companies found it impossible to raise more funds through share issuance due to the lack of investor confidence and the falling stock prices. With the dwindling dividends and no new capital, these highly leveraged holding companies failed and faced financial ruin. So the combination of excessive corporate debt, risky financial products such as bundling, and over-reliance on continuous economic growth created a fragile financial system. So that's the second explanation provided by the author for the cause of the depression. The next cause for the Great Depression was the vulnerable banking system. So there was a banking system in the late 1920s which was very vulnerable. Banks lent to each other but collapsed when any failed since the reserves were low and there were no regulations to reduce the risks. So in the late 1920s, US banks made what appeared to be safe loans secured by assets like real estate and stocks. However, when the stock market crashed in 1929 and asset prices plummeted, these loans lost value rapidly, leading to significant losses for banks. This situation was exacerbated by the fact that there was no insurance to protect bank deposits. So when banks failed, depositors lost their money entirely. So this caused panic among the public, prompting bank runs where depositors rushed to withdraw their savings, fearing further losses. The panic wasn't limited to failing banks. Even stable banks faced crises due to sudden demands for cash withdrawals. So there were not enough reserves. So as you know, banks operate on a fractional reserve system. Banks do not have reserves equal to the amount of deposits. So when there was a run on the bank, when people came to withdraw their savings and deposits, there was not enough liquidity, there was not enough money available with the banks, and that caused a banking crisis. Additionally, banks were highly interconnected through interbank lending, and they maintained low reserves, making them vulnerable to collapses. The second issue related is the low regulation on banks. There was a lack of stringent regulations on banking, and this further worsened the situation. So banks could lend money for speculative purposes, for investing and gambling on the stock market. There was no stringent regulations on the banks to control their lending activities. So as bank failures increased, a chain reaction occurred. The failure of one bank put pressure on others, leading to more failures and creating a widespread financial crisis. This banking collapse not only devastated the weaker banks but also dragged down the stronger ones, contributing significantly to the economic downturn and transforming a potential recession into the Great Depression. So based on these lessons, the Federal Reserve was established in 1930, and then also the Federal Deposit Insurance Scheme was also adopted to guarantee the depositors' money which was deposited in the banks. So the vulnerable banking system, which had low reserves and low regulations, was one of the causes of the Great Depression. So the next cause of the Great Depression was the issues related to the exports and imports in the US. So after the First World War, European countries were heavily burdened by war debts and struggled to recover. At the same time, the US implemented high tariffs to protect the domestic industries. So the US wanted the local domestic industries to develop, which if the imports were high, then the local economy, local industries would not develop. So they imposed heavy tariffs on the imports to promote domestic production and domestic industries. And this significantly reduced international trades. These tariffs made it difficult for European countries to sell their goods in the US market, and that limited the ability of the European countries to earn the foreign currency needed to pay off the debt. So it was a difficult situation. So they had high debts. They needed to pay and in dollars. To earn the dollars, they needed to export their goods into the US. However, because of the tariffs, they could not export goods. So they could neither export nor they had enough money, enough dollars to pay off the debt. So it was a difficult situation for the European countries. Now, this prompted the other countries to impose their own tariffs, leading to a significant decrease in global trade. So since the US was imposing tariffs and limitations on the imports, the European countries did the same. They started developing their domestic industries and stopped exporting goods and put limitations on imports. So neither the US could export and import, nor the European countries could import and export. So the reduction in trade had a direct impact on US exports, particularly affecting American farmers who were unable to sell their agricultural products overseas. So since the European countries also put high tariffs, the US, which had significant agricultural exports, they were not able to export because the European countries had blocked off their economies. Now it was a tit for tat situation. The American farmers struggled because they were not able to sell their products overseas. Additionally, as trade barriers went up, many countries found themselves unable to make payments on loans they have taken from the US, leading to defaults. So European countries defaulted because they couldn't earn enough dollars to pay off the US. So this trade limitations, both from the US side and the European country side, led to the loss for the US agricultural farmers, and also at the same time it caused losses for the Europeans because they were not able to export nor they were able to earn foreign currency. So that led to defaults. So these defaults combined with the falling export revenues contributed to the economic instability within the US. So in the context of the Great Depression, the US suffered on two fronts. Number one is the farmers, the American farmers, they suffered because they couldn't export. So they suffered, number one. The second issue was the defaults. So because the European countries were defaulting, they did not have enough dollars. So So the US suffered because of the defaults and the inability to export agricultural products. This series of events basically contributed to the economic instability in the United States. So the next cause of Great Depression is the ignorance of macroeconomics. During the early stages of the Great Depression, policymakers operated under the belief that the market would correct itself quickly. So there was the idea of the laissez-faire or self-correcting markets. This belief led to significant delays in adopting aggressive fiscal policies such as public works programs, which could have stimulated demand and reduced unemployment. Compounding the problem was the initial economic policy approach that prioritized balancing the budget over stimulating the economy. So what happens in a recessionary environment is that the demand goes down, so people reduce their consumption. However, in a capitalist economy, in a market economy, sales must continue. Sales drive the economy. So when the demand goes down, the sales go down. When the sales go down, then the production goes down, which means that there is lesser production, lesser income, and then when the income is less for the factories, for the industries, they would start laying off the workers. So the employment would go down. There will be high unemployment. So that's the cycle. So sales are extremely important. Sales and demand basically are extremely important. So what should have been done is aggressive fiscal policy, i.e., government should have stepped in with public works programs like infrastructure, building roads, and so on, which would have given income to the people, and that income would have stimulated the sales and production. So that approach of balancing the budget led to reductions in government spending and avoided tax cuts at a time when increasing public expenditure and reducing taxes were crucial to boost economic activity. So what tax cuts do is when taxes go down, people have more income. More income means more sales, more production, and so on. And more government spending also means more income in the hands of the people, and that leads to more sales and more production. The fear of inflation, despite the prevailing deflationary environment, further restrained the government from implementing expansionary monetary policies such as lowering the interest rates or pursuing a more liberal money supply policy. This combination of reluctance to depart from traditional economic principles and the fear of fiscal imbalance drove the economic situation from bad to worse. It prevented the implementation of necessary measures that could have mitigated the effects of the depression and assisted in a quicker recovery. And of course, soon after the Great Depression, then Keynes basically provides solutions and addresses this issue of the effective demand, how to increase the demand through fiscal expenditures, and how that can help in the recovery and coming out of recession. So those are the causes of the Great Depression according to the book. So finally, let's now look at the policy lessons from the Great Depression. So we've looked at the causes of the Great Depression, and now let's look at what lessons the economists and the policymakers can learn from the Great Depression. So first is the regulations on markets, banking, and corporations. So the Great Depression underscored the need for stringent regulations to oversee the financial markets, the banking practices, and corporate governance. Effective oversight helps prevent excessive risk-taking and ensures financial stability. So we want banks to be more responsible. We want them to be lending for real activities, not speculation on the stock market. So if bank lending is used for production, for industries, for real goods and services, then that would lead to higher GDP and overall welfare. However, if banks lend for speculation, then that leads to crises. The second issue is the stimulus through public works and spending, and that's the the fiscal policy, expansionary fiscal policy. The success of New Deal programs revealed the importance of government-led stimulus in combating economic downturns. Public works and increased government spending can provide immediate relief by creating jobs and injecting money into the economy, and thus stimulating demand and economic growth. So as I mentioned on the previous slide, so if the government prints money and it for example constructs a road, then that means the workers would now have money in their hands. They would go to the shop and they would buy bread and fruits and vegetables and house supplies, and then to be able to deliver and provide the goods to the worker, then the factories basically will start producing the required goods. So the money through the public works, money in the hands of the workers, would give a signal to the producers, and the producers would start producing, and the economy will be back on track. The third point is automatic stabilizers like unemployment insurance. Automatic stabilizers such as unemployment insurance play a critical role in moderating economic fluctuations. They provide immediate financial support to those who are out of work, maintaining consumer spending and providing a safety net. Again, so once a person is unemployed, then he gets insurance, some money from the insurance, and that money is used to increase the effective demand, and the cycle goes on. So all of these policies are basically making sure that this guy has money in his pocket, and then he starts buying things. So buying and selling and sales are the fuel of a capitalist economy. So that's very important. And then also progressive taxation. Implementing a progressive taxation system where tax rates increase with income ensures a fairer distribution of the tax burden. It also generates revenue that can be used for social programs and economic stimulus without disproportionately affecting lower income individuals. So the people with low incomes need to be taxed at a lower rate, so they need more disposable income, because these poorer people or middle class people have a higher marginal propensity to consume. So if they have more income in their pockets, they will spend on the consumption goods, and that will help the economy. So the richer people don't spend as much on the consumption goods. So these are some of the lessons. Thank you for watching.